A credit score is a numerical representation of an individual's creditworthiness. Credit scores indicate the likelihood of repaying debt. Lenders use credit scores to assess risk when evaluating loan applications. Credit scores are used for various forms of credit, including loans and credit cards. Credit scores typically range from 300 to 850. Credit scores are categorized into tiers: poor, fair, good, very good, and excellent. Each credit score tier affects the terms and interest rates on credit products. Lower credit scores typically result in less favorable terms and higher interest rates. Higher credit scores typically result in more favorable terms and lower interest rates. Understanding credit score ranges is crucial for managing personal finances and accessing credit. Payment history is the most significant factor influencing an individual's credit score. Consistently paying bills on time demonstrates responsible credit management. Responsible credit management positively impacts an individual's credit score. A positive payment history leads to a higher credit score and improved financial opportunities. Credit utilization is the ratio of the amount of credit used to the total available credit. Maintaining a low credit utilization ratio demonstrates responsible credit management to lenders. Ideally, credit utilization should be kept below 30% to improve creditworthiness. High credit utilization can negatively impact credit scores and borrowing opportunities. Strategies for lowering credit utilization include paying down balances and increasing credit limits. Consistently monitoring and managing credit utilization is essential for maintaining a healthy financial profile. Credit history length influences credit scores, with longer histories generally correlating with higher scores. A longer credit history provides more data for lenders to assess creditworthiness. Increased data availability enables more accurate creditworthiness evaluations. Lenders use credit history to predict the likelihood of future repayment. Establishing and maintaining a long, positive credit history is crucial for building a strong credit profile. A mix of different types of credit accounts can positively influence your credit score. Managing various credit products responsibly demonstrates financial capability. Credit cards, installment loans, and mortgages are common types of credit accounts. Responsible credit management involves maintaining low credit utilization and making timely payments. Opening multiple new credit accounts in a short period can lower your credit score. Applying for multiple credit accounts simultaneously may indicate higher financial risk to lenders. Spacing out credit applications helps minimize the negative impact on your credit score. Strategic credit applications demonstrate responsible financial behavior and can improve creditworthiness. A good credit score significantly increases the likelihood of loan approval. Mortgages, auto loans, and personal loans are more accessible with a favorable credit history. Lenders perceive borrowers with good credit scores as lower risk. Lower risk profiles make lenders more willing to extend credit. A strong credit score demonstrates financial responsibility and trustworthiness to lenders. A higher credit score enables qualification for lower interest rates on loans and credit cards. Lower interest rates translate to significant savings over the duration of a loan. Improved credit scores provide access to more favorable financial terms. Financial benefits associated with higher credit scores include reduced monthly payments and overall debt. Insurers often use credit information to assess risk. A good credit score can potentially lead to lower insurance premiums. Credit scores serve as one factor among many that influence insurance costs. Insurance premiums are determined by a complex evaluation of various risk factors. Landlords frequently assess credit scores when reviewing rental applications. A strong credit score enhances the likelihood of securing a desired apartment or house. Creditworthiness is a key factor in the rental application process. Applicants with higher credit scores often receive preferential consideration. Regularly checking credit reports from Equifax, Experian, and TransUnion union helps identify errors. Monitoring credit reports can reveal signs of identity theft. Correcting inaccuracies in credit reports can improve credit scores. Maintaining accurate credit reports is essential for financial health. Setting up automatic payments ensures timely bill settlements. Utilizing payment reminders helps prevent missed deadlines. Consistent on-time payments are crucial for building a good credit score. Missing bill payments can negatively impact credit ratings. Maintaining a good credit score opens opportunities for financial products and services. Lowering credit card balances reduces the credit utilization ratio. Credit utilization ratio is calculated by dividing the outstanding credit card balance by the total credit limit. Maintaining credit utilization below 30% is generally recommended. High credit utilization can negatively impact credit scores. Lower credit utilization demonstrates responsible credit management. Consistently paying down balances contributes to a better credit profile. A secured credit card can be a useful tool for individuals with limited or poor credit history. Secured credit cards require a security deposit, which typically acts as the credit limit. Responsible use of a secured credit card can help build or rebuild credit over time. The security deposit provides the card issuer with collateral, reducing their risk. Secured credit cards often report to credit bureaus, allowing for credit history establishment. After a period of responsible use, some secured card issuers may offer to convert the card to an unsecured credit card. Maxing out credit cards can negatively impact credit scores. Incurring late fees on credit accounts can lower credit scores. Applying for too much credit at once can harm creditworthiness. Responsible credit behavior is essential for maintaining a good credit score. Good credit scores are crucial for financial opportunities and stability. Avoiding credit mistakes contributes to long-term financial health. Please subscribe to the channel and hit the notification bell so that you will be updated for more videos.